Tesla recently became the seventh company to hit a market value of over $1 trillion. Joining the ranks of big tech, the company's share price has skyrocketed since the start of 2020. It overtook Toyota in July 2020 to become the world's most valuable carmaker by market capitalization. Since then, Tesla's share price has increased 5 times over to reach more than $1,000. At present, it is worth more than the next 9 most valuable public car makers combined. That is a stunning turnaround for a company that was previously ridiculed for being unable to produce 2 consecutive quarters of profit. But what makes Tesla so special? Why do investors value the company so much higher than any of its rivals? To answer that question, a bit of background is needed on the seismic shift the car industry is currently undergoing. In the last decade, governments around the world have been implementing policies promoting electric vehicles at a rapid rate. These support mechanisms were implemented to help stimulate a major expansion in the number of electric car models offered by companies. In order to close the gap between the price of conventional and electric vehicles, governments provided subsidies for EV purchases. As the number of EVs on the road increases, more convenient and affordable charging stations are also needed. Governments have helped develop this infrastructure through direct investment and providing incentives for EV owners to install charging points at home. Additionally, many cities have made themselves more friendly to EV owners. For example, through the implementation of low and zero emission zones that penalise owners of vehicles running on an internal combustion engine. More than 20 countries have mandated a full phase-out of ICE car sales by 2050, and more than 120 countries have announced an aim to reach net zero over the next few decades. Electrifying road transport will be crucial to achieving this. The results of all this have spoken for themselves. Electric car sales broke every single record in 2020. They were up more than 40% compared to 2019, despite the sales of all cars falling 16% in 2020 due to the global pandemic. 10 million electric vehicles were on the road in 2020, and that figure is expected to grow exponentially in the coming years. That puts Tesla, an all-electric vehicle company, in a very good position. But other traditional car makers are also offering electric vehicle models and have decades of experience that Tesla doesn't. So why is Tesla so highly valued? Firstly, Tesla is not your usual car manufacturer. Car makers typically sell mass-market cars in single-digit profit margins. If Honda produces a car for $30,000, they might be looking to sell it for around $32,000, a profit margin of roughly 7%. But Tesla has managed to charge gross margins of around 30% on each car sold due to the integration of hardware and software. The firm has landed on a unique profit model, selling a full self-driving software upgrade for $10,000 up front or $199 a month. These kinds of fees represent a new model of income for car makers and are almost pure profit. Some investors expect 75% of Tesla's future revenues to come from subscriptions as it licenses software to potential partners such as legacy automakers. This is entirely new for car manufacturers and has given some investors the expectation that Tesla will be vastly more profitable than its peers. Another reason for Tesla's sky-high valuation is the company's determination to not be seen as just a car manufacturer. Beyond generating income from software services, the company also profits from charging, maintenance and insurance, and sells powertrains, batteries, and carbon credits to other manufacturers. Tesla's leading battery technology, the development of its own custom AI chip, and the vast amounts of data it collects from more than 1 million drivers gives it a unique advantage that will be difficult to replicate, or near impossible in the case of established car makers. One of the biggest advantages Tesla has over its older rivals is that it is so new. Established automakers are trying to compete in EVs while dragging along their huge ICE legacy businesses and related workforces. Many of the existing factories would have to be shut down for an extended period and retooled to accommodate pure EV manufacturing. All this while Tesla makes its cars faster and generates higher margins than its competitors. A Model 3 is built in 10 hours, 3 times faster than a Volkswagen ID3. Even the targets that some established automakers have put forward are unambitious. Toyota's aspirations for zero-emission vehicle sales is just 1 million by 2030. That is Tesla's current annual output. The final reason for Tesla's astronomical valuation is Elon Musk. His loyal following among some retail investors has no doubt contributed to a rising share price. Tesla has turned this into a serious competitive advantage. Once a company goes public, it does not directly benefit from a higher share price. However, if it offers secondary stock offerings to raise more money from investors, a higher share price makes raising capital cheaper. If a company wants to raise $1,000 and its share price is $100, it would need to create 10 new shares. However, if the share price is $500, only 2 new shares need to be issued. In the past 3 years, Tesla has raised over $13 billion in 4 stock offerings. Given that car manufacturing is so capital intensive, it pays to have the cheapest cost of capital. Tesla's success is far from guaranteed. Should other manufacturers catch up to it in terms of battery technology and EV manufacturing capabilities, they could pose a serious threat. Decades of expertise providing superior build quality and long-established customer bases are no joke. The geopolitical tensions between the US and China also pose a threat to Tesla, with China being a key market for the company as well as a big source of manufacturing. The increased scrutiny of regulators around self-driving capabilities could also dampen Tesla's expansion into these key development areas. And a failure to ramp up production to the 50% year-on-year growth that the company expects would significantly reduce revenues and Tesla's attractiveness to investors. The other $1 trillion companies that Tesla has joined have near monopolies in their respective industries. Perhaps the current valuation of Tesla assumes a near global monopoly of the car market. Whether such a future is plausible is impossible to know. But as Tesla continues to storm past its competitors, that future is looking increasingly likely.